Welcome back to the CPA Revolution. I'm Sharina Padilla here with our tax strategy expert and co-host, certified tax coach and CPA, Jose Ortiz. If you are tired of traditional reactive CPA advice and want to turn taxes into a wealth building tool, you are in the right place. Good morning to another session of the CPA Revolution. Today we have our marvelous CPA and tax coach, Jose Ortiz. And joining us today, we have an amazing guest. Jason is joining us today to teach us a little more of what's happening with qualified opportunity zones funds and the sunset that's coming up in 2026. This is a great topic that we all need to learn from because most investors only think about taxes when it's too late, after the sale of a property, after a gain, or after the IRS has already claimed on their profits. So today we're going to break this down. Jason, thank you so much for joining us. And Jose, take it away.
Yeah. So Q4, here we are, Q4, guys, right? Faster than we ever anticipated. This is how it always works. And this is the time now where we're going to talk about mitigating, right? Sales, capital gains from sales of businesses, of property, whatever it may be. So we've talked about Section 1202 in a previous episode. So you guys can go back and check that out. And that's one way to fight off capital gains from sale of business. Now, we're going to talk a little bit more about qualified opportunity zones, because I think this is humongous, especially with the enhancements from the OBA bill this year. So I have my friend Jason here. Him and I have worked together before. He's a great guy. He's the managing director for Alternative Tax Management. It's an educational platform focused on tax mitigation strategies for accredited investors and their advisors, me, right? Holistic tax-centric planning solutions are provided through a nationwide network of financial, accounting, legal, real estate, and insurance professionals. And Jason and I usually get together for three reasons. Besides just liking each other and shooting the breeze, it's when I need capital transition strategies, right? So when I have these clients that need a 1031 exchange, maybe they need some income tax mitigation. So I'll call them, if they have high W-2 earners and they need a way to offset that. And tax credits, because tax credits, to me, one of the best things you can have, right? Way better than deductions. So I always call him to see what we can do as far as mitigating some tax bills with tax credits as well. So Jason, how you doing, my friend, today?
Doing fantastic. Thank you both. Appreciate you having me on.
Absolutely. So Jason, you are our first guest on this. You should feel honored. So let's talk a little bit about QOZs. Talk to me. What is a QOZ?
So a Qualified Opportunity Zone Fund was structured in the Tax Cuts and Jobs Act years ago. It was really an incentive that was put in place that was initiated by some really wealthy folks in Silicon Valley that were sitting on mountains of capital gains from their tech stocks. I think one was a PayPal investor and early investors in some of those startup tech companies. And so they realized they had a significant tax liability if they were to translate those stock positions into cash in their bank account. And they wanted to be socially beneficial, because even though they would drive around in their really wealthy Silicon Valley area, they would see that San Jose had areas that needed some capital infusion. Not all areas were wealthy. So they had friends in Congress that they went and they lobbied and said, you know what? We want to invest in these communities to help them out, but can you give us a tax break? Because we're sitting on these mountains of capital gains. And, I think there's a good proposition here. And then was born the Qualified Opportunity Zone Fund. So qualified opportunity zones are in each and every of the 50 states. And it was really set up by the governor of each state to really zone out within their geography based on certain demographics of income, what was designated as an opportunity zone. And the initial opportunity zone, there was a deferral of the capital gains tax. So you could trigger a capital gains tax liability, and you had 180 days to roll that capital gain into a qualified opportunity zone fund. And unlike a 1031 exchange where you have to use a qualified intermediary and you can't have constructive receipt of the proceeds, you could sell an asset, and as long as you roll it in within 180 days, it's self-reporting. So you could just file it with your taxes, a statement that said, yep, I rolled it into an opportunity zone fund. And the first benefit is a deferral where you could defer the tax. The second benefit was a step up in cost basis. And the third benefit, which is the biggest, and we were talking about how it's a great comparison to a Roth IRA account, which is all the growth of these investments. And typically they're higher trajectory growth investments like ground up development of apartments and multifamilies, oil and gas programs. All the growth, you have to be in it for 10 years. But after 10 years, you could pull the money out tax-free. So if you invested, say, $1 million and it grew to $2 million, you could pull that money out completely tax-free. So very much like a Roth IRA. Additional benefit with that growth aspect is the income that's generated along the way is mainly tax-free as well with a lot of the programs because they're using cost segregation, they're using depreciation or depletion and things like that. And one of the benefits of the opportunity zone, unlike doing it in a taxable account or structure, if you were to sell something for a profit outside of the opportunity zone fund, it would trigger a recapture tax. With the opportunity zone fund, no recapture tax, and you could basically keep all of your gains.
That's wild to me. When you're getting someone into these QOZs, an investor, right? One of the things that we should kind of look at and explain to them too is that we're kind of like multi-layering tax strategies because you bring up a cost segregation. That in and of itself is, right, a strategy for reducing tax. Depreciation, all those kind of things that we're rolling up in there, right? All of that is kind of a benefit of the QOZ, aside from what you're going to receive, right, tangibly.
And the most beautiful thing about this opportunity, what I'm getting from it, is that you could turn your tax bill into an investment, right? That builds something real. So you're not only benefiting yourself, but you're creating jobs, you're creating housing, you're investing in local businesses while giving yourself that tax-free growth. And this is just an amazing opportunity that everyone should know about.
Exactly. You know, and if you're the kind of person that likes to give back to your community, this is a great way of doing it, right? We're taking places that need economic development, right? We identify opportunities, and then someone else is doing this for you, all of it, and you're just investing in that capital that you would have had to pay a tax otherwise. So this is really, really cool. Jason, I know that some people are at home listening and they're going to say, well, this is a long-term play. And yeah, it is. What happens if I need to take that cash out, Jason?
Well, generally, these are relatively illiquid investments, but some of the programs do have some liquidity provisions after like a 6-year period. Most of it, as I mentioned, is ground up development of real estate projects. So with that, there really isn't any opportunity to cash people out. The money's going into ground up development of these assets. But once they're stabilized, there's a few different things. Some of the programs do a refinance event to shift from construction financing to permanent debt. And when they do that, some of them kick out a capital distribution to the investors, which is treated as a return of capital. So there are different ways that there could be liquidity events.
Yeah, you know, and I say that because obviously we talk a little bit here about mindset, well, all the time, pretty much. And this is one of those things. We're talking strategy. We're not talking, you know, hey, how can I get rid of this $500,000 capital gain tax bill in year one? That's not what this is. This is a long-term play. So you want to have the advisor, obviously, that can kind of show you these opportunities, or have people like Jason to help you, sift through these things. And then B, we have to kind of coach, our clients up, right? This is a long-term play, but this is something that can be incredibly beneficial, especially now, Jason, with the enhancements in 2025. Can you talk a little bit about those?
Yes, definitely. So with the first version of the Qualified Opportunity Zone Fund, it is sunsetting and expiring December 31st of next year.
Yep.
And so some of the original features, such as a step up in cost basis, that's gone away because you can't be in it for 5 years to get the step up at this point. And, the deferral period at this point is only 12 months because you're deferring to December 31st of next year. And so with the new big, beautiful bill coming in, they had actually made Qualified Opportunity Zone funds permanent, which is fantastic. And Unfortunately, they didn't do anything to help the current iteration. This is going to expire December 31st, but right. The new wave of Opportunity Zone funds kicks in 2027. And as I mentioned, it's permanent, and it has the same three general features that are beneficial, which is the first being deferral. But instead of going from a deferral, whereas right now it's a deferral until December 31st of next year, it's a rolling 5-year deferral. So if you invest in 2027, you're able to defer all the way to 2033 and then pay the tax in 2034. And it's a rolling window each year thereafter. The other benefit is a step up in cost basis. After you're in it for 5 years, you either get a 10% or a 30% step up, depending on where the projects are. And they've added, one of the detractions from the current version, a lot of people were complaining about maybe the zones were a little too easy. Maybe they were already areas that were gentrified in the upswing. So they wanted to add a rural distinction for areas that might need additional support. And so there's a 30% step up for those areas. And then, of course, our comparison to the Roth IRA, the 10-year tax-free benefit is still there. So to me, that's always been the biggest.
Yeah, there's nothing else like that. That's why I love the QOZ. Now, so we have these rolling periods. So that's even better. But of course, this is going to require someone, a tax advisor who can obviously keep up that schedule for you and do all those kind of things. So you want to work, again, with someone who has experience working with QOZs, and can manage that on the back end for you guys and not miss a beat, right? Jason, as far as where we can reach you, if one of our clients or one of our listeners wants to find you, where can we find you?
Well, you can check out our website, alternativetaxmanagement.com. We've got a lot of educational content on the site, and you could reach us through there. You could schedule through that actual website. But we're very educational in our approach to, letting people know the risks, the benefits, and the different attributes of each of the different programs.
And one more thing, I guess, that just popped into my mind. For these people who have the December 31st, 2026 deadline popping up, obviously they're going to have a tax bill. What are some of the kind of things that you can think of off the top of your head that they might want to look at? Because obviously now they have to pay the capital gains, right? So what kind of things can you kind of maybe off the top of your head suggest for them?
Well, I mean, some of the current programs actually do some neat things, like they're able to revalue the capital gains. And the rule is you pay the tax on the value the day that the capital gain was triggered, or December 31st of 2026. And we actually use this strategy in discounted Roth conversions, where you're able to take a development real estate asset and from an accounting perspective, price in future expenses into the present value and actually reduce the valuation by upwards of 40%. So that's the first thing. It's kind of like that step up in cost basis, where when they do get the valuation on the capital gain, it's lower. The second thing, Jose, is I mentioned capital dispositions where they do financing events. Some of the programs have designed like a 3.8% distribution in 2027. That's a very distinct number. That's 20% capital gain, 3.8% net investment income tax. Yeah. And so they're targeting a distribution to help you pay your tax at that point. And others could be, larger, like upwards of 50% distributions over the period of 27 to 2030. So a lot of different options.
That's wild. So you and I will be talking about this coming soon within the next year. But guys, how can you not get excited about this stuff, right? It's crazy. This is just crazy stuff. Trina, I don't know if you had any other questions that you had for Jason, maybe?
No questions. I think that this is just another golden nugget that we need to keep handy, because it's not just looking at this reset as a loophole, right? I always say, let's not focus on the loophole. Let's build that roadmap. And Jason brings that to the table, right? So understanding the ins and outs of how this strategy would work, and then partnering up with a strategic CPA that's going to be able to design what happens next and structure that gain. And obviously timing, it's always good, right? So timing, the entry, and then matching those real estate projects with other options that you can stack onto each other. So I'm so happy and blessed to be here, learning another topic that brings more value to investors and high net worth individuals, and look forward to working with you both in the next few months as we plan our end of year tax planning sessions. So
yes, and we'll be posting Jason's information in the chat, on our Substack chat. So look out for that, and we'll include some other QOZ information. I'm going to actually include the link to the HUD website. That way you guys can see for yourself how many of these things are out there, and just the different types of things, whatever floats your boat, because there's different kinds of projects. So again, guys, thank you so much. Everybody out there, thank you until next week. And I think next week we'll be talking a little bit about maybe 1031 exchanges. So stay tuned for that. Thank you, everybody.
Thanks for having me.
Thank you.
Thank you.
Thank you, Jason. Have a good one.
You too. Take care.